They did not wait for the opening bell. The official futures markets for 2026 have not opened yet. COMEX is still closed for the holiday, but the private market already sent a shockwave through the system. Less than an hour ago, intelligence confirmed that a major private transaction between an industrial buyer and a wholesale supplier failed. This was not a paper trade. This was not a futures contract. This was a physical agreement for January delivery. The buyer arrived with the cash. The supplier reviewed the new Chinese export rules, checked their vault inventory, and then said the one word that ends systems. No, this was not a delay. This was not renegotiation. This was a default. It did not appear on an exchange ticker. It did not flash on a trading screen. It happened quietly in the off-market physical deals that keep the real economy functioning. And this is the first hard confirmation that the China export ban is not just policy language. It is a physical wall. Look at the sequence. Markets closed for the holiday. The China export ban activated at midnight. A private physical deal was attempted this morning. The supplier failed to deliver. All of this occurred within 24 hours of the vault doors closing. If you are looking at your phone right now, you still see yesterday's close. Around $70, $60. That number is a ghost. It is a museum artifact from 2025. Because in the real world, today, the price to actually acquire silver is exploding, while the paper price is frozen in time. In this emergency broadcast, I'm going to explain exactly what this private default means for the system. I'm going to break down the $12 premium surge that exposes the real price. I'm going to tell you what to expect when electronic markets open tonight. And I am going to give you a clear strategy for the first trading week of 2026. The paper price is asleep. The physical market just woke up screaming. Yesterday, the warning was clear. When China locked the vault at midnight, paper and physical would separate. It took less than 24 hours. Here is what is happening right now in the wholesale market. The screen still shows roughly $70.60. That is yesterday's official close. That is the number financial media will quote when they reopen. But in the private market, where real metal actually changes hands, premiums have exploded overnight. Wholesale sources are reporting $12 over spot just to secure physical bars. $12. That means the real price is $82.60. Let that sink in. The screen says $70. The metal costs $82. The gap is $12 and widening. This is the moment the pricing mechanism breaks. The paper market is frozen at a fictitious price. The physical market is sprinting toward reality. The connection between the two has snapped. The export ban did not merely restrict supply, it shattered price discovery. When the markets reopen, algorithms will trade paper contracts endlessly. Paper is infinite. Contracts can be printed without limit, but industry is now operating in physical reality, and that reality is empty. So when you see $70 on a screen tonight, understand what you're actually seeing. That is not the price of silver. That is the price of a promise. If you hold SLV or unallocated accounts, you own silver at $70. If you want to hold metal in your hand, the entry price is already $82. That $12 difference goes straight into the system. Anyone panic selling at the paper price is donating value to the banks. Now let's explain why the private default happened today. Because this was not a choice. In a normal market, a shortfall is solved with money. A supplier simply buys metal on the open market and delivers it. The system functions because metal exists. Today, that option was gone. Why? Because of the list of 44 suppliers exposed yesterday. The Chinese refiners responsible for roughly 40% of global refined silver are offline. They cannot export without government approval. And that approval is not being granted. Australian exports are flagged. London inventories are draining. The wholesaler who rejected today's deal did not walk away willingly. They physically could not source the 1,000-ounce bars required. This is the distinction that matters. A price crash is financial. You can print money. You can inject liquidity. You can bail out institutions. A shortage is physical. You cannot print atoms. You cannot legislate silver into existence. When the metal is gone, it is gone. What happened today was not a financial failure. It was a physical failure. The cash was present. The silver was not. History shows this pattern clearly. In 1980, during the Hunt brothers squeeze, private defaults surfaced weeks before the public collapse. In 2021, PSLV halted share creation because physical bars could not be sourced fast enough. Premiums exploded while mainstream voices claimed nothing was wrong. The sequence is always the same. First, private deals fail, then premiums surge, then insiders panic. Only later does the public price adjust. We are at step 1. When COMEX reopens, watch the registered inventory. That is the metal available for delivery. Industrial buyers are waking up. They understand what happened this morning. And they will rush to secure supply before the vault is empty. This is why the number on your screen no longer matters. $70 cannot buy metal. It can only buy a claim. When electronic markets open tonight, expect an attempt to control perception. Low liquidity favors manipulation. The goal will be calm. They need the world to believe nothing happened over the holiday. I expect aggressive tape painting, possibly a smash lower. $68, 60 some cent, maybe even $65. Why? Because a visible gap to $85 would ignite public panic. They need you to wake up tomorrow, see $70, and assume the China ban was irrelevant. But the truth is already known. A delivery failed. Physical trades are clearing at $80. The two-price system is live. Here is what to expect next. If paper is smashed, premiums will widen. If paper rises, premiums may hold. Either way, the gap grows. By January 10th, expect additional private defaults to surface. Premiums expand to $15, $18. Real price mid-80s to low 90s. By mid-January, retail inventories drop sharply. Delivery delays spread. By February, private market trades challenge $95, $100. Spot is now a lagging indicator. Premiums are the signal, so here is the strategy. When markets open tonight, do not react to the first candle. Liquidity will be thin, algorithms will hunt stops. Let the machines fight. If paper collapses, let it. Every dollar lower accelerates physical demand. Cheap paper with high premiums is a gift to real buyers and a disaster for the system. If you hold physical silver, do nothing. Your metal did not lose value. The screen did. If you hold paper claims, understand your counterparty risk, read the fine print. Know whether delivery is real or optional. If you're waiting to buy physical, understand this clearly. There's no $70 silver. That price exists only digitally. $82 is reality today. Wait for confirmation on the screen, and you will pay $95. This is the moment the system exposes itself. The private market just declared what the public market has not yet admitted. The metal is scarce. The price is distorted. The gap is widening. While most people celebrated the new year, you were paying attention. Less than 24 hours into 2026, the first delivery failed. The two-price world is no longer a theory. It is here. The music stopped today, and the people holding real metal already have a chair. Happy New Year. The gap is opening.
Hello, my dear friends. How are you? So I hope you are fine and welcome to my new informative video. So, friend, this video you did not wait for the opening bell. The official future markets for 2026 have not opened yet. COMEX is still closed for the holiday, but the private market already sent a shockwave through the system less than an hour ago. Intelligence confirmed that a major private transaction between an industrial buyer and wholesale supplier felt this was not a paper trade. This was not a future contract. This was physical agreement for January delivery. The buyer arrived with the crash. The supplier revived the new Chinese export rules, checked devalued interest, and the sad the one that the one that and system know this was not a delay. This was not recognition. This was a default. It did not appear on exchange tracker. It did not flash on a trade screen that happened quickly now in the off market physical deals that keep the real economy functioning, and this date is the first hard confirmation that is China export ban is not just policy language, it is a physical wall. Look at the sequence markets close for the holiday. Thank you.